Good morning, everybody, and welcome to this, our June installment of IFRS and Corporate Reporting webinar series for 2024. My name is Kevin Frohbus. I'm sure many of you know me, and today you'll see a new face on the screen, although it's not that new because Dean Ardern has actually presented with us previously on these webinar series. So welcome, Dean, to our session today. Good to see you. It must be colder down in Melbourne because you've got a jersey on. So obviously it's colder in Melbourne than it is in Sydney.
Yeah, thanks, Kevin. And yes, it is colder in Melbourne, but that's why we live here.
I'll do formal introductions in a moment, but just to say welcome to the topic, recent advancements in financial instruments. That's part of the reason why Dean's on the call today. Dean is a director in our IFRS and corporate reporting team based in Melbourne, and he has a special affinity to financial instruments. In addition to his day job, he also sits on some of our global technical groups, as do a number of us, but Dean in particular is focused on financial instruments. So we thought it would be a good idea to bring Dean today to actually take us through this topic. But it also coincided very nicely with Aletta being overseas. So Aletta's actually on global break today. She's traveling overseas, so she left me in charge. And of course, that means I've made some executive decisions, hence Dean is in the room. So welcome, Dean. It's lovely to have you here. And we'll get right into it. It is the last webinar session we're having before the June year end. So there's a lot going on, and Dean and I were just talking earlier that actually it is starting to get busy out there. Year ends are starting to come. People are dealing with sustainability issues, but also just the usual issues, which is why we've put this topic where we have, because it's always a good idea to keep in the rearview mirror or in the screen in front of you the financial instruments. They tend to always crop up when you least expect it. Before we get into it, I will just acknowledge, put an acknowledgement through to country. We would like to acknowledge traditional owners on the land we meet, and that's across the nation, not only in Sydney and Melbourne, and extend our respect to elders past and emerging. Before I hand over to Dean, who is going to drive the majority of the session today, and I'll probably just throw hand grenades in as we work through it, I will just remind you where we are in our webinar series schedule for the year. We're up to the June advancements in financial instruments. For those of you who are still getting ready for your 30 June year end, just a reminder that we did do in May an update on financial and sustainability reporting. That was our 90-minute update on really everything you need to know about your upcoming year end, your June year ends. So if you haven't watched that one in particular, please go back and have a look at it. It is available free online together with all the other topics we've already covered. And as part of the reporting cycle that we normally face at this time of year, impairment will be a big issue. It's an ASIC focus area. It's always one of the hot topics. And so in July, we will be looking at impairment, understanding the what, how, and when of conducting impairment testings. Most organizations, except perhaps maybe the big listeds, wouldn't have reported by then. So it's still relevant to your 30 June close to attend the July session on impairment. And then I'll actually just kind of lead that into our other series, which is running at the moment, which is our sustainability webinar series. Now, Aletta and I are spending a lot of time talking to clients about the upcoming mandatory sustainability reporting regime, but our sustainability webinar series doesn't only focus on the mandatory regime, it focuses on more broadly voluntary reporting as well as climate specific risks, opportunities and assessments. And in our June webinar, which is only a few days away, we'll be looking specifically at the interaction between voluntary and mandatory sustainability reporting. So that's our topic of the month. So getting right into today's agenda, Dean, you're going to be on the hook soon, is today's agenda. Dean is going to be taking us through, as the title of today's webinar, the big issues that keep coming up or sort of recent developments in this space. Now, I'm going to simplify this down to say that the big topic of the day is still, as it always has been, equity and debt classification. It's clearly not going away. There's a lot of developments there, lots of discussions and lots of emerging issues. So that does seem to be the flavor of the day today. But there's also some other things in there that we are coming across on a regular basis. Lots of organizations are refinancing, rolling over their liabilities. So Dean's going to focus on what's called the 10% rule. He can take you through that. And then we'll get into things like warrants, classifications of financial instruments, and then characteristics of equity, which is the big debt and equity. And then question, which always our problem. Do these instruments, are they debt or equity when issued by the issuing entity? And then finally, there will be some developments in the renewable sector. There's a lot going on in the energy sector, not only because Australia is going through an energy transition, but globally this is happening. Very timeous link to sustainability and climate-related reporting, but there's lots going on in the IFRS space, in particular in the renewables and energy sector. And one of the issues Dean will take you through is contracts for renewable electricity. So, Dean, I'm going to hand over to you soon. So, a reminder: we have all of the stuff available on our website. We've got a very detailed financial instrument topics page, which you can download, and our favorite guide, which I know a lot of people still use the guide on accounting for convertible notes, has been recently updated. The links are there. It should be easy to find. But if you are struggling to find it, just type BDO accounting topics into your Google browser, and it'll be the first thing that pops up, and you'll be able to find the topics page that way. So, Dean, on that note, I'm going to hand over to you.
Thanks, Kevin. Yeah, so what we did just about a week ago, Kevin and I had a quick discussion around sort of the different topics, and I remember thinking when I sort of started thinking about the topics in this area, I thought, oh, you know, there's probably not been that many we could cover. And then when I actually went back and had a look at it, there was a lot more than what I sort of had originally sort of imagined. And so what we've done is tried to cull down the number of topics down to just some very specific ones, and some ones that we think have probably the biggest implication for entities across the board. Some of these topics are older, and some of them are obviously in an exposure draft sort of stage. And I thought it'd be helpful to sort of look at those older ones too, to remind people about certain things that have been decided by the standard setters, but maybe haven't sort of filtered through, or maybe you haven't had the need to look at them at this stage. And so just a reminder that they are out there and that they're affecting practice. I thought it was also useful to look at some of the things that are developing, because there's going to be some quite detailed discussions around these developments in the next 12 months to 18 months. So as Kevin mentioned, the equity liability question is always an ongoing question, and it actually has implications also for the current non-current classification issue that's been going around about financial liabilities as well. So the ISB is looking to change, or has changed the requirements around current, non-current, and changed some of the requirements about classification for instruments that are extinguishable using equity instruments. So they have wider ramifications, but what we try to do is pick some topics today that we thought that might be impactful for everybody and have some use to people in their practical 30th of June requirements this year. Kevin, if you want to roll on to the first topic around the question around what you do with fees and other costs associated with a modification of a loan agreement. I thought it was worthwhile just retouching on this one, because we do see it coming up. Not every entity modifies a loan every year, so they don't necessarily have exposure to these requirements regularly, but just to remind people how it actually works. I'll put together a couple of slides here. The example is very much focusing on quantitative assessment of significance. So sometimes you need to consider whether or not the modification is both quantitative and qualitatively significant. I'm not going to look at the qualitative aspects today. The kinds of qualitative aspects we're sort of talking about is if, for example, I don't know, if you changed your loan from USD to Australian dollars or vice versa, or if you had an arrangement whereby you entered into a modified arrangement that had a conversion feature. That would be a qualitative change, which we would normally sort of say, look, that's probably significant. In this case, we're really talking about just quantitative, so I just want to focus on that. So going effectively back to 2021, the ISB received a request to clarify what the fees are. And as you can see there in the slide, I've provided both the existing requirements and the ISB amendments. I suppose the key part is to look at it and say, in the existing requirements, there was a discussion around where you need to include the fees and costs associated with the modification. Now, somebody who was obviously dealing with this and would probably had a significant dollar value around fees said, well, actually, what are we talking about here? What kind of fees and costs are we talking about here? Because I'm going to probably incur some fees with the lender to modify this arrangement, but I'm also going to probably incur some other costs of my own. So I might have to go and get some more legal advice, or I might have to pay maybe other professional fees I might have to pay associated with the arrangement. And so the question was, what fees and costs do I actually include when I'm thinking about the modification? So the ISB said, well, actually, really, we're only concerned about those fees and costs that are between the borrower and the lender. So it's not between the borrower and other parties or between the lender and other parties, it's just those between the borrower and the lender. And also importantly to remembering that we're talking about both fees paid and paid for on behalf of the borrower or lender. So we're not dealing with just simply the cash ones, we're dealing with if someone paying them on behalf as well. So the ISB provided those amendments which effectively clarified what they were talking about in regards to what are the costs and fees. We might roll on, Kevin. So when we do the calculation, this is more of a diagrammatical sort of presentation of it. When we do the calculation, we have to think about what was the present value of the cash flows under the new terms. So thinking about, so if I'm trying to determine the 10% limit and whether or not this is a substantive or substantial qualitative modification, I have to compare effectively what will be the cash flows going forward, including any fees paid, net fees received. So anything between the borrower and the lender, discounted at the original effective interest rate. So I'm keeping everything the same. And then I compare it to the discounted present value of the remaining cash flow. So the original carrying amount of the loan, assuming it continues to be carried at amortized cost. Now, if I discover that the difference between those two amounts is 10% or more, I've got a quantitatively substantive difference. And so therefore I'm in that right hand, sorry, in the right hand as I'm looking at it. So as you're looking at it, in the left-hand side of the diagram, I've got the substantial quantitative modification. So I've got to effectively de-recognise the existing financial liability, recognise a new financial liability. And when I do that, what that does is, yes, the difference recognised in the profit and loss, but the critical part about that process is I'm going to have to determine a new interest rate and a new effective interest rate to amortise the new loan. If I now looking over to the right-hand side of the screen, if I've got a situation where quantitatively it's less than 10%, the difference between the new amount and the pre-existing amount, I've got a non-substantial quantitative modification, and therefore the carrying amount will be adjusted, but I would continue using the original effective interest rate. Again, the difference would be recognised in profit and loss. So the two approaches are the same in the sense that the truing up is between profit and loss, but there is a difference, and you can get a difference. And I suppose if you think about, say, compared to now versus maybe if you had entered a loan 5 years ago, then you might conclude that at the moment interest rates are very different. So you might find that difference between the carrying amounts would be very different now as compared to maybe 3 or 4 years ago. Sorry, Kevin, go on. So to try and demonstrate this, I've provided this as an example. ABC Limited obtained a loan from XYZ Bank, $100 million on the 1st of January 2001. Key features include the transaction costs incurred were $5 million, so this is on the original loan. The loan's a bullet loan, so it's fully payable. The principal's fully payable in 5 years, but there's an interest rate that's paid per annum of 7%. Now, during the course of the loan, due to financial difficulties at the end of 2003, ABC Limited discussed with XYZ Bank the prospect of debt restructuring. So XYZ Bank agreed to the restructuring on the following terms. So the term of the loan is extended by 2 years, so out to the end of 2007. Interest rates revised to 9.75% per annum, and the bank charges fees of $2 million for the restructure. ABC itself incurred legal fees of $1.5 million for the modification, and for the example, we'll just assume that that's paid to an external third party, not to the bank. The amortised cost of the loan at the end of 2003 was $97.76 million, and the original effective interest rate was the loan was 8.26%. So based on those fact patterns, if you do a calculation, you can see from this slide, you can see how it would go about it. So you can see there the revised cash flows up front. There's a $2 million in year zero, effectively. That was the transaction cost we've included, and then we've got the renewed balance and interest payments over the term of the renewed life. Now, when we do that present value calculation, including those fees, we get a $106.9 million balance. Now, the original, as I think the previous slide had the original balance at 97.76 million. So the difference between those two amounts is 9.14. If I put 9.14 over 97.76, I get 9.35. So less than 10%. We don't often work in bright lines in accounting, but unfortunately this one does work in a bright line. We have a 10%, so we can say, look, this is non-substantive. Kevin, if you want to roll on to the next slide, we can show the relevance of that too. Now, if you look at that, and so if we just focus on the left-hand side there for a minute, the measurement of the modification loss. So you can see that the carrying amount, 97.76, that's the carrying date amount, less the revised carrying amount, which is the 106, but I minus the 2 million because that's what I do with these types of loans. If I was to just recognise that loan on day one, I've got 106 million's worth of loan, but I deduct those direct transaction costs. So the 2 million is the direct transaction cost. So I get 104. So the modification loss is 7.14. Then when you actually look at the accounting for it, you can see that the 7.14 is recognised in profit and loss, but then the additional 3.5, which was that's the total costs, will be then recognised as a reduction against the carrying amount of the liability. Now, by doing that, it effectively means that I'm including those all costs in the carrying amount. I'm not necessarily including them in the gain or loss on the modification of the loan. So it makes it clear that you need to include the costs and fees when you're trying to determine whether or not this is significant, but those costs and fees will be treated in accordance with, IFRS 9 or AASB 9 as a reduction in the carrying amount of the loan when you recognise the loan. So making that distinction really helps also to make sure that, and you can imagine probably what was driving the original requester, the original person that went to the IFRIC and asked the question, they're probably dealing with very large balances of transaction costs. And so we're trying to understand, well, actually, what do I include here? Because if I include them or not include them, potentially I'm going to get a different outcome. And so that's probably what drove that original query. Accounting for warrants. This one, again, probably gives a little bit of context to this one. Again, this was discussed in 2021 by the IFRIC. Now, the interesting thing is this has been an ongoing issue, and we'll actually come back to this topic sort of later in the presentation. But one of the key features of this issue has been the absence, I suppose, of guidance in AASB 132 and in IFRS 9 and so IAS 32 and IFRS 9 or AASB 132 and AASB 9. The lack of guidance or the lack of requirements around subsequent measurement or subsequent classification of financial instruments, particularly those that have conversion features. So originally there was somebody was dealing with this issue. They've gone to the IFRIC and asked a question about how do I deal with a situation where I've got an instrument that when I originally recognised it, effectively it didn't meet the fix for fix criteria. So there was the prospect that I was going to have to settle this instrument in a variable number of shares. And so on initial recognition, we classified it as a financial liability. But then for some reason, further down the track, something happened and effectively it became a fixed conversion feature. So there might have been some contingent event in the arrangement that said, if certain things don't occur, then from that date onwards, the conversion ratio is 1-for-1 or it's fixed in some way. And so the submitter actually asked, well, look, what do I do with this? Like, do I continue to recognise this thing as a liability, or do I recognise the fact that in substance now it is an equity instrument because conversion is a fixed amount? So I've provided the existing requirements there on the slide, and really was just to highlight the fact that we have pretty clear requirements on initial recognition of financial liabilities, and the fix for fix rule, notwithstanding it sometimes requires some judgment to apply, it is pretty clear in the sense we're talking about a fixed number of instruments for a fixed price or a fixed instrument. But there's no discussion of subsequent accounting and subsequent classification of those arrangements where, for whatever reason, something happens and the conversion feature goes from variable to fixed. So provided there, I'm not going to go through it, but we've provided there, obviously that's our flow chart that we use often when we're dealing with financial instruments with conversion features. And as you can see from that, it doesn't contemplate subsequent classification issues. It simply just says, well, on initial recognition, you've entered a contract. What are the terms of the contract? If the contract allows a conversion of the instrument into a variable number of, or an unknown number of equity instruments, then we treat it as a financial liability, but otherwise we treat it as equity. Now it was interesting, this is not definitive guidance, but I thought it was interesting to sort of provide in the sense that this came out of one of the IASB staff papers. So when they actually, this went to the IASB and the question was asked by the staff. Often when staff are required to present positions to the IASB, they will play devil's advocate and they'll provide a couple of different views. And this was on the basis of, so it wasn't just staff's views, it was interesting, the staff had done some outreach to various countries and actually asked the question, well, what are you doing about any situations you get where there is a subsequent change in the classification feature, or the classification of a conversion feature? How do you account for it? And they've actually found that there was multiple views. There's effectively 3 views. So view 1 being the issue is prohibited from reclassifying the warrant because the accounting standard simply says you do it on initial recognition. We don't revisit that initial recognition classification and we move on. Others came back with a different view, view 2. There's actually an accounting choice because the accounting standards don't say anything about it. Then presumably it means that it's open to applying the hierarchy in IS 8 and actually working out what your accounting policy should be. Alternatively, view 3, the issue is required to reclassify the warrant. So consistent with the substance of the arrangement, we should always be presenting it as if on the basis of what it is. So if in substance the conversion feature has become an equity instrument, then we should actually reclassify it as an equity instrument. So it's interesting that even not just amongst the ISB staff, but obviously among constituents around the world, there was different views on how this should be dealt with. I thought this was also interesting to highlight because this came out of some ISB staff discussions as well, because when they started delving further deeper into this issue and started trying to explore the different circumstances when this occurs, they found there was quite a variety. So they weren't really just talking about financial, warrants with conversion features. They talk about all sorts of financial instruments with conversion features. So obviously they mentioned the warrant in the first dot point there. But they also mentioned instrument issued by a parent that will be settled by the parent delivering a fixed number of a subsidiary's equity instruments in exchange for a fixed amount of cash. So it starts off as equity, but then what happens is if the issuer loses control of the subsidiary, they're no longer issuing their own shares in exchange for converting that instrument. So effectively that instrument became, as a consequence of losing control of the subsidiary, the instrument became a financial liability. So again, a situation changes, you get a different outcome. The last 2 dot points, the instrument requires the issuer to deliver cash or another financial asset only if the contingent event occurs. If the contingent event's not within the control of the issuer, but subsequently the contingent event does become within the control of the issuer. So if you imagine a situation where, for example, there might be some threshold event that occurs that, for example, if an entity has issued instruments that say, look, if prior to going to IPO, these can be converted into a variable number, but if we get approval to go to IPO, and whether or not we do or not, it's in our control, that changes the conversion feature. That would be a situation where you might look at this instrument again. And so during that time, once the IPO approval has been granted, that instrument might be considered an equity instrument from that point onwards. The last one, which I have seen in practice, is a variable number of shares being issued as part of a contingent settlement in a business combination. So we did have a client who was involved in a business combination. They'd acquired another entity. They said that they were going to issue a variable number of shares as a consequence of a EBITDA and other sort of performance criteria for the subsidiary. The determination of the number of shares was effectively on one reporting date, but the shares were only going to be paid at a future date. And so from the date on which the criteria had been met to the date on which those shares are being effectively issued, that instrument was still outstanding, but the number of shares to be issued was fixed from that point onwards. So we had an issue, obviously, trying to determine exactly what the accounting for it should be. Kevin, have you seen anything similar or like that?
No, not similar to the one you've seen. We've seen the instruments being used in different ways contemplated by the standard, and I think that's probably the theme that's coming out of here is if you think you've seen everything, wait 3 months because it sort of changes again. And I think the theme that's coming out of this is accounting standards were written for classification at initial recognition, and then it didn't really contemplate what happened afterwards. And business doesn't work like that, and the economy is changing really quickly. So the sorts of interest, the instruments we're seeing are designed in such a way that they might look one way at the start, but as events unfold, they become fixed. So I think we've probably seen the same sort of instruments, not in a business combination. I haven't seen it, but I've certainly seen it in other ways and means. And I'll give you another example. The warrant issue that I keep running into, it's not quite what you're dealing with today, but suddenly warrants are being issued to customers. They're not financing arrangements. They're essentially arrangements to bring customer business to the business, and they're essentially giving an incentive to customers or customers of customers to try and introduce new business, and they're using warrants to do that. But similar type of thing, they become fixed at some point down the chain when they
Yeah.
start off variable. So they essentially have multiple different types of interesting combinations of variables inserted.
Mm. Yeah, look, I think it's a really interesting area because, like as you say, often these accounting standards were written at a time where some of these transactions and events were just not contemplated. And as much as I, being involved in standard setting in a prior life, as much as I found it really interesting, the one thing I sort of took away from that was, notwithstanding everyone's trying to be principle based, when you're actually writing an accounting standard, you have to really think of certain transactions to think about how to write the requirements. And so as a
Yeah.
consequence, it's a catch-22. So to get the right requirements, you have to sort of think about certain transactions. But what it does is it eliminates or excludes other potential transactions that might occur in the future that you obviously don't know about, but you don't contemplate either. Which is a theme that pops up a couple of times in this presentation. So it's quite a prescient sort of idea.
I'll make a quick comment, Dean, not to interrupt your flow, but
Yeah.
it is also worth trying to understand what they were trying to achieve when they designed the features. That doesn't necessarily answer the question, but sometimes you see it clearer and then you can apply the
Mm,
principles a bit easier. Going back to the business combination one, which was based on one number versus it issued was another date and it became fixed and it went from variable. The question you really have to ask yourself is, what were they trying to achieve? What was the economic
mm,
consequences or substance of that, and then it may actually lead you to the answer. We tend to, as accountants, not us, of course, Dean, we're far more advanced than this, but accountants tend to go straight to the rules in the standard and apply it, but they don't actually stand back and say, well, what's actually going on here? And
yeah.
sometimes that makes it a little bit easier to see, but it also means that you need a bit more time to analyze these things. You
Mm,
can't leave them till the last minute. You really need to understand what's going on, and why, what's the economic consequences, and who was designing the feature.
mm. Yeah. Oh, it's absolutely correct. Like that there is it's proportional, that time that people put into an instrument to develop it and to write it, to then for someone to come along and actually interpret it and understand what the accounting is. So the longer you put into an instrument, the more complex and sort of detailed the negotiations are. You need to sort of really understand that might not obviously the same length of time, but that the more complex the instrument is, the more time it's going to take someone to sort of work their way through and get to that point where they go, yep, no, we're comfortable with this accounting now. So that's a really, really important point. Thanks, Kevin. Um, in terms of the IFRIC's finding on this, so the IFRIC's not a standard setter, it's an interpreter. So what tries to do is try to maybe fill in the interpretive gaps that exist in standards. It doesn't rewrite standards, but it does have the capacity to refer issues to the ISB. And in this case, it actually said, well, look, there's no interpretation we can do. The standard is what it is. There's a certain, it says you classify an initial recognition, and it says you do certain other things. So it's potential that there's multiple views here, and until somebody in a standard setting context looks at this, we probably can't make a determination on it. So you might say, well, why am I telling you about this? I suppose the good thing about knowing about the IFRIC's determinations is it sometimes gives you good pointers where to look, but it also it's sometimes useful in telling you what something isn't. So it doesn't always tell you what it is, but it might tell you what it isn't. The IFRIC might actually have some ideas about saying, look, certain things we don't think apply, but we do agree it's in this sort of area. So the interesting thing was this was actually picked up by the ISB as a part of its FICE project. So we'll talk about this again in the future, but I might get you to roll on to the next slide, Kevin, but the key part, I suppose, to remember about IFRIC decisions are that they aren't necessarily binding in many ways. So one is that sometimes the determination doesn't have a strict statement. It's just simply saying the IFRIC thought it and said, look, we think the standard is sufficiently detailed to get you to an answer. In that case, they're not really giving any sort of guidance, but it does tell you that, oh, okay, I need to look within the standard, not outside of it. The important thing, though, to remember is that IFRIC is only really working in the context of very specific fact patterns. So you need to be very careful about extrapolating from IFRIC findings on very strict fact patterns to other fact patterns which are not necessarily exactly the same. The IFRIC requirements are, if they are determinative, if it does change accounting practice, then obviously they need to be applied as soon as possible. I mentioned some guidance there around what ASIC's expectations are, but typically it's usually within the next reporting period. So moving on to classification and measurement of financial instruments. This one popped up out of, this is a standard sort of thing that the ISB does with all of their new standards, is that approximately about 3 years after they issue the standard, what they do is a post-implementation review, particularly with the major standards, just to make sure that they're working as intended, there isn't any fatal flaws, but also it gives people an opportunity to say, well, look, there's some things, if you provided a little bit more guidance here, we could get more consistency in practice. And so that's been pretty much what has been found as this part of this post-implementation review of IFRS 9. It was first discussed way back in, well, effectively a couple of years ago, but it's only just come to the fore now, and the ISB actually have released the standard. I think they released it on the 30th of May, so the amendments are out. They're not effective until I think 1st of January 2026, but they are actually in place now for consideration. Now, it was interesting. It was as a part of the post-implementation review, there was some interesting things popped out of it, and there were things that, and I've listed there under the amendments to IFRS 9. One of those, the settlement of the electronic payment system. Obviously, we've had electronic payment systems around for a long time, so no one's ever sort of questioned it, but an interesting discussion came out of that. The other one is the ESG linked features on some instruments, and that's obviously new. And so it's not surprised that got picked up as a part of this post-implementation review, because just straight after pretty much IFRS 9 was issued, that you started to find entities were issuing things like loans with ESG linked features in them. The ISB also took the opportunity to have a look at some of the disclosures and give some more clarity and perhaps some additional disclosures to assist users around understanding certain things around financial instruments measured at fair value through OCI, and also some with contingent features and discussing those. So I might just break these down just a little bit, and hopefully the EFT one I might go through, because the interesting thing, this is not necessarily an accounting technical issue, it's actually more like an audit issue, but we realised that we probably needed to do something in the accounting world to fix the audit issue. I mean, we all use electronic payments transfer systems, so we all understand how they work, roughly. I mean, we make we initiate a payment, pretty much at the moment we initiate payment, money leaves our account, and then a couple of days later, effectively, money appears in the transferee's account. Now, from a financial asset perspective, that gap in time doesn't really pose too many problems, because if I'm thinking about it as a creditor and I'm waiting to be paid, I don't really get paid until the money appears in my bank account. I can't do anything until such time as the money appears. I can't use that cash. The entity that's providing the electronic payment system isn't effectively guaranteeing that payment, and it's not standing in the middle. So I can't turn to the electronic payment transfer provider and say to them, my money hasn't arrived yet, can you lend me some money while I'm waiting for that money to arrive? So there is a gap, and I can't do anything until I recognise that money in my bank account. Now, that's typically seen as settlement accounting. So we sort of say, look, that's consistent with settlement accounting. The arrangement wasn't settled until the money appeared in your account. So effectively, you're not going to recognise the financial asset until you actually get the cash. So they had that discussion, and then as a part of that discussion, they realised, oh, but what about if we look at it from the other perspective? So if we look at it from the perspective that the entity that's paying the cash, on the day that they initiate the transaction, the money leaves their account, in their nominal account. It's for 3 days, it's sitting somewhere with the electronic payment transfer provider. And then 3 days or 4 days or 5 days later, it appears in the bank account of the entity that I'm trying to pay. If, however, I'm looking at the balance date and I'm doing a set of financial statements at the balance date and I'm the auditor, I'm looking at my client's bank account and I can see the money's left. But I know that if it left it on the 30th of June or the 31st of December or whatever my balance date is, if that money left my bank account on that reporting date, I know that the liability hasn't been extinguished on that date. In fact, the money is somewhere in between me and the person I want to pay. And so as a consequence, I haven't necessarily extinguished the liability on the day that I've paid it using an electronic payment system. And that was the problem that we realised. Now, from an accounting technical problem, we just sort of go, well, we shrug it, we shrug our shoulders and say, look, that's okay. Look, that's not a technical issue. That's just a practical issue. But from an auditing perspective, obviously that's a challenge, because now the auditors are having to look at it and saying, well, I can see the money's left my client's bank account, but I can't see it in the recipient's bank account. I don't have access to that. And so I can't necessarily determine that liability has been extinguished. And from the creditor's perspective, maybe they don't think the liability has been extinguished. They haven't received the cash. They haven't been given the entitlement or ability to control the cash. So they sort of say, well, actually, the liability still stands. So from an auditing perspective, we've got this concern that we've got cash leaving the bank account, but we don't have and the liability may not have been settled actually with cash, but we don't have an intervening asset like we used to do in the old days when we had, checks in between, written but not presented, that sort of scenario. Kevin, do you want to roll on? So to fix that problem, and I think it is a significant problem, I suppose, technically, what the ISB has done is proposed that normally we would use settlement accounting. So normally we would say, well, once it hits the bank account and it's settled, that's fine. But what we can do is we can make an exception for electronic payment systems. Now, we can make that exception, but only if, as a consequence of the money leaving my bank account, there is no way known it's not going to get to, or the risks of it not getting to the recipient's bank account are very, very low. And so what we want to be able to say is we can assume that the liability is extinguished on the day that it leaves my bank account if it meets those criteria. So there's no practical ability, I don't have as the payer, the practical ability to withdraw or stop or cancel the payment instruction. I've got no practical ability to access the cash, so it's not sitting in some other account before it goes to the recipient. And there's an insignificant settlement risk associated with the electronic payment system. And helpfully, the ISB have said, well, look, when we think about settlement risk, when you think it's insignificant, it's got characteristics such that the completion of the payment instruction follows a standard administrative process, and the time between initiating a payment instruction and the cash being delivered is short. So, the standard 3-4 business days, whatever it is. If we're concerned that something is not significant, what we're dealing with is if the completion of the payment instruction is subject to the entity's ability to deliver the cash on the settlement date. And I think what the ISB in this situation was saying that if there is some doubt about the effectiveness of the electronic payment system, then, and it can't be relied on necessarily to clear in a timely fashion, then you would have to say that settlement doesn't occur, and therefore we can't use this exception in IFRS 9 around electronic payment systems as a way of extinguishing liabilities.
Dean, I'll just make a quick comment. I'm glad you mentioned the check thing, because while you were talking, I was thinking, wow, this was like checks back in the 1980s when you and I were young. Or maybe I was young and you were just old already.
Yeah,
But
I was always old. Yeah.
the point I wanted to make was really, it's actually an old issue made new in a different way, and that is because these issues are the issues are becoming operationally linked to IFRS. Now, in some sectors like the banking sector, the IFRS standards were always operationalized. We just didn't see it in those sectors. But more and more, shall I say, mainstream clients and companies across the board are starting to integrate IFRS into their operational aspects. So these issues are sort of popping up at the international standard setup because this is an issue everybody would face. But it also means that things like paying electronically is becoming widespread. Obviously, it's been there for some time, but cash is no longer around. But it goes back to the same thing on the 10% rule that Dean was talking about earlier. Don't underestimate the impact of what looks like small number of transactions actually on the reported results, because you can see how quickly you get to a different outcome on derecognition of a liability purely based on how you treat the transaction costs. And normally transaction costs are an afterthought. Well, it's the same with settlement on these things at the year end. It can fundamentally change your balance sheet depending on these on these answers, and then you have liabilities that haven't been derecognized. Suddenly your covenants are at risk, etc., etc., etc. So really do pay attention to the stuff. It's really important.
Yeah, and I'm sure it's the practicalities that cause this issue. Like you say, it's been there forever, but I think what's probably happened is that someone along the line has had to obviously pay, maybe in the past has been paying large balances of outstanding payables on the reporting date, and then had to think about, normally receiving cash or paying cash, we think about it as, a progression of transactions over a year. There's usually no great lumps, there's not a lot of lumpiness, but I suspect that this was driven by someone who's dealing with lumpiness. So
yeah, that's right.
the ESG linked one's an interesting one because obviously that's relatively new. And in a nutshell, basically what we're seeing now, I'll ask you to, I'm sure you've got some good examples of this as well, Kevin. So I'll get you to weigh in this. we're seeing a variety of instruments being issued now. I mean, it started off with banks looking at their customers and saying, look, we'd like to maybe adjust our interest rate that you pay on a loan for certain ESG criteria, certain emissions, or certain governance or social other criteria that we think is useful to you, but also beneficial to us as a lender. And so we're seeing a lot of instruments now that have ESG criteria linked to the interest rate. Now, you might say, well, what does that matter? Well, when everyone wrote, when the standard setters wrote IFRS 9, they didn't think about these things. And so they very much thought about classification of financial instruments, particularly financial assets, based on the nature of it. So they very broadly classify them into, plain vanilla type loan arrangements and everything else. Now we've got ESG, which is somewhere in between. And so all of a sudden the banks are saying, well, if we start issuing these loans with these ESG features, can we continue to call them at amortized cost, or do we have to, fair value them? And so this has created a lot of discussion. I've only dropped a couple of slides in here, but this has been 12 months worth of discussions have been going on around this whole issue and trying to understand how to interpret, in the context of the current standards, how do we interpret this ESG linked criteria, and because it affects interest rates. And all of a sudden, is it now a case that we no longer meet the solely payments of principal and interest criteria that you need to meet if you want to get amortized cost measurement? And that's the real crux of this issue. The ISB, I'll get you to roll through, Con, yeah. Just a couple of examples there. These are type ones, that the ISB staff had seen. We've seen similar ones. Kevin, have you seen any different ones again?
No, they're all variations on a theme. The instruments seem to be linked to an E, an S, a G, or a combination of features, and it affects the interest rates. I mean, at the end of the day, that's the substance of what's going on. I haven't really seen the indices one yet. I know you've got it up there. I think that's starting to make its way into the Australian vernacular.
Yeah.
The variation that I have started to see though is normally what would happen is you'd have an ESG link feature that would just be dictated by the lender, let's say. But now what's actually happening is the lender is actually negotiating with the counterparty before they lock the agreement in. So there's almost a negotiation beforehand to agree on the ESG feature, and then they price the interest rate.
Yeah, okay.
It's still not really changing much of the debate on the slides as you have, but it's just the way the organizations are engaging on these is starting to change. It's not so much I'll give you X rate if you do Y. It's actually, if we can agree on what you're going to do, then I'll price my risk. So the lender's actually almost part of the governance framework now, and
Yeah, that's really interesting.
they're
Yeah.
inserting themselves into the organization's risk management processes and governance before the borrowing is granted. They're actually
Yeah.
actively involved, and some of them are even attending board meetings to monitor that, which is
Okay.
at an observer level. So that's something I've started to see really quickly happening.
Yeah.
But the
Wow.
accounting perhaps isn't necessarily driven by who attends the board meeting, but it starts to make you wonder who's actually got some sort of interest in the business beyond just it being a loan, and that starts to open up things like associate accounting and all those types of things, almost
Yeah.
like PE or venture capitalism by stealth.
Yep.
And that might be something to keep an eye on.
Yeah, but it goes to that point again. Going back to, as you say, not jumping straight to the rules, actually asking yourself, what's the substance of this
What's going
transaction?
on
What are
here?
these people doing? What's going on? And when you start to see stuff like that, it does change your perception of what
Yeah.
exactly the accounting should be. So yeah, for sure.
Look, I mean, I know I'm wasting a little bit of time, but I'll just be clear on the main example I saw. Generally, the commercial banks are issuing these, let's say, green loan. They're not necessarily asking for a seat at the board. They're essentially maybe helping you set the targets, and then they block the instrument down. If the loan is coming from another type of investor, maybe from the US, that changes the relationship really quickly, because they're not just issuing a green loan. They may be actually trying to insert themselves in terms of some sort of position on the board, whatever. And I have started to see embedded in those a conversion option, which when you don't meet the feature, instead of it changing the interest rate, suddenly there's shares involved again. So of course, they're starting to get aggressive, and that's normally coming from venture capitalism, private equity, and really anybody who's got cash to burn.
Yeah. Well, actually, I did see one yesterday where it's a sort of a customer / financing arrangement back to backs, and and one of the features was the financier was taking a position on the board of the entity. So it is. I mean, it is consistent with the idea that we do, that the banks and other entities that are involved in this are negotiating deeper and with longer term sort of views than just simply providing cash and being part of that business. So no, that's really interesting. So I think I've probably mentioned all of the technical challenges there. The issue really is that how do we interpret the current requirements in light of these new features? So do we actually, how do we view them? Because overriding in IFRS 9 is the idea that, if you want to get solely payments of principal interest and you want to have an amortized cost measurement model, you basically have to have this sort of plain vanilla, house mortgage type loan arrangement. And if you don't have that, then it's potentially going to be at fair value through P&L. That's going to be obviously a problem for banks because they wouldn't have the systems necessarily set up to deal with that at this point in time. So the question was, well, is it something else? So is maybe changes in is these adjustments in the interest rate as a result of ESG? Is it a credit risk adjustment, or is it got something to do with the lender's profit margin, or is it just not significant and we don't worry about it, or is it not genuine and we don't worry about it? So this is where the discussions have been to date. And so what the ISB has done is actually proposed to some additional guidance. They realise that this, obviously ESG loans are not going to go away, ESG criteria is not going to go away. Lenders should consider different elements of the interest separately. So actually looking into it and saying, well, actually, is it, when we put this in and you put in an ESG criteria that changes interest, is that a reflection of the profit, the margin that you need as a lender against this entity because of the risks it exposes to you as a borrower, or is there some other feature going on? If they're being compensated for risks that are not typically considered to be basic lending risks or costs, so the value of equity instruments or the price of commodity, share borrowers, revenue, those sort of things, then we'd say, well, that's not consistent with SPPI, so making that absolutely clear. So for example, if the arrangement is linked to an index, then we'd say, well, that's not really based on the credit risk of the customer. That's got something, that's a market type feature which really should be dealt with through fair value. I mean, you need to assess whether contractually specified changes in those cash flows following the occurrence of or non-occurrence of that contingent event are consistent with SPPI, but contingent event must be specific to the borrower. So really, the ISB is making it absolutely clear, look, it's possible. You guys are going to have to do the work because it's a principle-based model, but these are the sort of boundaries in which you have to work, that you can't simply, and I think the last point there is probably the most important bit, the idea that the ISB is saying, look, there's no exemption for SPPI requirements for ESG linked instruments. You have to make the assessment. You have to just do the work. There's no exemption. There's no out. You have to be able to be in a position to explain why you think adding that ESG feature does or doesn't cause the instrument to be reclassified to something else. I won't skip through that. I provided that one as an example, but that was an ISB stuff. I might skip through these ones as well because these are quite nichey, but basically, I suppose to give a bit of a background, very quick background, often entities will set up structures in which underlying the structures, there might be things that look like loans, but what happens is the cash flows to the instrument holders might not look like interest. And so some of the discussion that the ISB have been having around these two things, and it's come out as part of this classification and measurement exposure draft, people are saying we need more guidance. Like, we're trying to understand what's going on here, which criteria and which guidance do we apply to these types of things, how do we assess it? And what the ISB have done with these types of instruments have tried to actually give a little bit more guidance to people to say, well, if, as a consequence of the way the structure, you always have to look through the structure, you always have to look through and understand what's going on underneath it. But if, as a consequence of looking through it, you can see that there are debt-like instruments underlying the arrangement, and the cash flows look debt or debt-like in the sense that you're getting solely payments of principal and interest, and if there's a default on the asset, then you've got an interest in that as well. Then effectively you can continue using amortized costs for these instruments. But I think what the ISB is trying to make it clear is that if underlying an arrangement that you are getting returns on some arrangement that are effectively returns of the performance of an asset, like a license, the performance revenue based, something like that, that's not in the nature of interest and principal payments, then effectively that thing has to be measured at fair value.
Yeah, and I'll just make a comment on that. It doesn't only apply to pools of investments in financial instruments. It also applies to structures like infrastructure SPVs, where there's a waterfall feature. So some of those, we see a lot of those as well.
Yeah, no, exactly. The sort of the last point on the classification and measurement is that the ISB, they did receive some feedback from constituents around disclosures and saying, well, we think that certain things could be disclosed better. And one of the things that they wanted, that quite a few respondents sort of indicated they'd like for was a breakup of the fair value movements, the gains and losses during the period, breaking them up between realised and unrealised, particularly for equity investments designated at fair value through OCI. So usually what happens is sometimes at the end of the year, what happens is you might have some of those equity instruments might have been realised, some have not realised, but effectively none of the gain or loss is actually ever put through P&L. It all goes through OCI. And so for some users, they sort of said, well, we'd actually like to know how much they made on those disposed assets vis-a-vis assets they've retained. And so it'd be helpful if you could make those distinctions in your disclosures. The other one there on the right-hand side of the screen, not surprising that the ISB said, look, ESG is an issue and maybe we need some more disclosures around what is causing the interest rate on some of these instruments to change. What's the criteria? What's the ESG features that need to be that we need to disclose and understand? I think I might skip through this one, Kevin, relatively quickly, just in the interest of time, but also just to sort of highlight, I think we've really sort of touched on, and Kevin touched on at the start of the presentation about saying, look, the issue is distinction between equity and liabilities. And it creates all sorts of problems because, you think about, if I classify something as an equity, all of the distributions on that instrument will go below the line. If I classify it as liability, all the distributions are above the line. And so it has ramifications right through the financial statements. So the fix for fix rule is a really good principle, but the problem is in practice, it can be challenging to apply because we have lots of different features in instruments, and trying to weight those different features and determine whether or not they themselves are equity or liability in nature, and whether the instrument as a whole is equity or liability in nature. I suppose I could probably quickly skip through these things, keeping in mind that FICE is so the ISB has issued the ED. They started with a discussion paper, they issued an ED. This is the current ED. The kinds of things that we're dealing with are, and the kinds of things is, how do we take, for example, laws and regulations into account when we're trying to assess whether or not an instrument is a liability or an equity instrument? A good example of that is like a bail-in feature, and what we often see in debt instruments that banks issue. Often the bail-in instrument is if the, for example, regulator says that to the bank, look, you're no longer financially stable, we need you to stop, that, you can no longer pay interest on this debt, you have to actually waive this debt, or you have to actually cancel it. Whether or not that actually is a feature we need to think about, whether debt or equity classification. So the entity itself has issued debt, but if someone else could tell them just tomorrow that it's no longer effectively debt, does that change our classification? Is it become equity at that point in time, or has it actually always been equity? So it's those sort of issues that we've sort of been dealing with. Settlement and own equity interests is always an issue. We've always had issues around understanding what do we do when we've got fix for fix, like if we've got things like, and we call them anti-dilutive or make whole adjustments, but how do we deal with those? Typically, we sort of look at them and say, well, look, it's really just keeping people on the same level. But if in fact they use things like volume weighted average price, for an instrument to try and determine what, the fair trade is does that create a liability? Because normally we think of conversion features if they're using a price like a VWAP or an actual market price, we tend to look at them and say, well, actually that's a liability because I don't know what the price will be in the future when the instrument's converted, and therefore it has a variable number of instruments. So there's been a whole lot of issues around that. Down round features, which are things where if an entity issues shares at a lower price than what they issued the instruments to you at, then obviously the conversion feature gets changed. So is that an equity instrument because maybe the entity can control whether or not it issues further shares and therefore enacts the down round feature? There's always issues, and there's lots of things. And again, it reflects when the standard was originally written, it probably didn't reflect it. In principle, it was trying to identify the key features, but it didn't necessarily have the benefit of, or standards didn't have the benefit of all of the different issues that we now deal with and the different, different contractual arrangements that we now have available to us. I might move on to, again, same sort of issues, the settlement of the issues. The contingent settlement one, this is probably one I wanted to probably just touch on quickly, is that we often see this where you might have a situation where a loan is payable or an instrument is payable in the event of something occurring, and that thing is not that the entity issuing the instrument doesn't control, and nor does anyone else. So, we typically sort of think about things like if you go into liquidation. Now, the standard makes it clear if you go into liquidation, then if that's the only reason you might settle the instrument, then we wouldn't regard that as causing it to be a liability. But often we get scenarios where you get, the instrument will say if you start to enter into administration, and that could cause you to actually have to convert the instrument into a variable number of shares. So how do we interpret those features? So the ISB have provided some guidance around that as well to sort of say, look, we think that this is a good way to go. We think that we should define things like liquidation like this. How do we look at non-genuine? How do we because with non-genuine features, we might put them to a side and they don't affect our classification. So the ISB is sort of looking at how do you deal with those contingent features. And again, we mentioned it before about the warrants, but they have actually provided some proposals with regards to reclassification of financial liability and equity instruments post initial recognition. And it's interesting what they are really focusing on is that general requirement that prohibits the reclassification of financial instruments after initial recognition, except where, for instance, the substance of the contractual arrangement changes because of a change in circumstances external to the contractual arrangement. And so what we'd be talking about is something like a change in a contractual term by another party to the instrument, or for example, something that affects the way that the instrument is being issued. Things that are internal, so for example, conditions which say after a certain event or after a certain period of time, the conversion feature becomes fixed, that wouldn't necessarily lead to a reclassification of the instrument under these proposals. So the ISB is making very clear that they're saying, no, initial application is where we see the classification to be fixed, and it's only going to change if there's something external happens post effectively the issue of the instrument. A couple of other proposals there. The interesting ones coming out of that they want to sort of, obviously there's always been issues about whether or not an entity's ability to do something which is subject to shareholder decisions, whether or not that could be considered to be controlled by the entity and therefore an equity instrument or not. So the ISB are providing some guidance there. Some really interesting proposals around the presentation of disclosure. The key one is that they're thinking about trying to make a third category of equity of other equity holders. So instruments that give rise to equity but aren't share capital, perhaps separately disclosing those as a part of the financial statements, and obviously further information around sort of debt-like and equity-like features within instruments.
Before you do this one, Dean, I'll just kind of say that if you're issuing instruments which can convert to shares, a little principle has worked really well for me in life, which is the 3+30+ rule. And you might have heard me use that before. And what I basically say is if you've got a contract with somebody which may or may not be settled in shares, and the definitions are more than 3 pages long and the contract's more than 30 pages long, it probably means it's complicated. And a lot of the issues that Dean has been talking about are probably embedded in there. You probably need some help. So that'll be my takeaway for you if you have those contracts. If it's a 1-page definition and a 2-page contract, it'll be easy.
Yeah, thank you for that. I've never heard that one before, but like I work on a similar principle when I say to people, if you can't tell me in a minute what the issue is and you have to put it in an email in dot point, then it's probably complicated. Yeah. So yeah, no, fair point. Last topic, contracts for renewable electricity. Again, this is one of those ones that falls into the bucket of, we didn't know this was going to occur, so the accounting standards weren't prepared for it. But it's an interesting fact pattern. But basically, it's a situation where an entity has effectively engaged with a power supplier to take all of this power supplier's power. And now in doing that, the issue is with power because of the nature of the market at the moment. When you agree to take someone's power, particularly renewable power, there might be issues around consistency in supply. So, for example, the sun sometimes it doesn't shine, the wind sometimes doesn't blow. You don't necessarily always get a smooth production of power with renewable electricity. But you agree as an entity to say, look, I'm willing to take that risk because it helps me with things like my ESG strategy. It helps me with my my renewable targets. The problem with that is obviously then you have to deal with not only undersupply but oversupply. So from time to time you might find that the wind blows harder than you actually expected, and all of a sudden you've got more electricity. Now, typically electricity is one of those things that you don't want hanging around the house. It's best to actually put it back in the grid and make sure someone else uses it. And often this is what the contracts will say, is that if you can't use electricity, the supplier will force you to put it back in. Well, effectively the supplier will do it for you. They'll put it back in the grid and they'll give you whatever spot price is at the time. But what that creates is a differential between what you're paying on the electricity and what you're actually selling it for. And when you start to get those differentials, that's when you start to head into the financial instrument world. And so previously, a lot of these entities were sort of probably because that they were receiving electricity from more fossil related sources, that there was a consistency of supply. But now, and so therefore they could fall into what we call own use. So with own use contracts, where we can see that you are using what you're buying, and notwithstanding the prices might be predetermined, and they might be different from what the market is at any point in time, because they're there for own use. We sort of say, okay, that's like an executory contract, and we can say, look, we're not going to recognise a derivative on it, because it's like any other supply agreement. However, with this sort of scenario, all of a sudden there's a differential. The question was asked, can we continue to classify these for own use, or do we have to treat them as a derivative? And that was where the IFRIC came in, and they said, well, look, this is an interesting topic. We're not sure that we can deal with this. We think it's a standard setting issue. And so it elevated itself up to the ISB. But the interesting thing is that it sort of expanded when it got to the ISB, because all of a sudden people started saying, well, actually what I'm doing with this contract is creating a hedging arrangement, because what I'm doing is prepaying for electricity in the future for forecasted transactions. I'm going to need to use electricity in the future, so I'm pre-buying it. Can I apply hedge accounting to it? And in the current context, when you think about the hedge accounting requirements, one of the things with the requirements in hedge accounting is that you have to define what your hedged instrument is, and what your hedging instrument is. And if you're hedged, if you're not quite sure how much electricity you're going to be generating in the future in this, it's very hard to determine what your hedged item is with any accuracy. So if to avoid, if you can't do it with accuracy, what happens is the hedge accounting, it falls apart and you have to discontinue it. So they were really stuck in the sense of saying, I can't use the current hedge accounting requirements. I'm not sure whether the derivatives apply to this. I've got problems with trying to understand what my accounting was. And that's sort of the basis of the discussion. The ISB took all of that on board and basically said, look, we're willing to give you an exemption. We're willing to carve out this particular situation from the typical hedging and from the typical own use requirements, because we noticed that the standards currently don't really accommodate this type of arrangement. But what they did is said, look, we're only going to allow this for certain types of contracts. So the contracts that we'll allow this for have to have the following features. The source of production of the renewable energy is nature dependent, so that supply cannot be guaranteed at specified times or for specified volumes. And examples of such sources of production, obviously things wind, sun and water. And the contract exposes the purchaser to substantially all the volume risk under the contract through as pay as produced features. So the idea is that you're actually, you are taking on whatever is produced by the producer of the electricity. The volume risk's yours, and that's what creates the issue around your own use and in terms of your hedging requirements. We've provided there a slide just to sort of explain, but the two questions are, can this continue to be own use? So if you previously treated this contract as own use, can you continue to do that? The ISB provided some guidance on the kinds of things you need to look at. The guidance obviously acknowledges that when you're dealing with this, there's going to be some volume risk. The question is, how do I be able to demonstrate to my auditor that volume risk is not problematic in the sense that it's going to cause me to actually treat this as a derivative? So you need to look at obviously considering about what your average use is going to be, what your future use is going to be, how you're tracking against it. I think ISB they're not providing a get out of jail free card here by saying it doesn't matter, as long as you buy it from renewable electricity, you're fine. What they're saying is you have to keep assessing this. More importantly is that just because you don't end up, you end up putting sort of some of the electricity back in the grid, doesn't necessarily preclude that you're saying its own use. And with regards to the hedge accounting, it basically is saying that, again, another exemption is saying, look, if you can designate the hedging, the variation, the volume of electricity, which you designate as the hedging instrument, then effectively all that you're going to be hedging then going forward is the price, then you can apply this. But it is important to probably in this sort of situation to be able to also anticipate clearly what you need and how much you think you're going to actually get. And obviously a few disclosures, but the interesting thing about these disclosures is that previously own use electricity contracts weren't necessarily subject to specific disclosure requirements, but they will be now under AASB 7. So 7 is including both virtual, so your typical derivatives that you might be using to hedge, and own use contracts. Both now are going to be subject to disclosure under 7. Obviously, these requirements are not issued yet, but when they are, then they'll be effective for that period of time.
Right, Dean, I'll say I'm going to assume that you've covered all the topics you wanted to cover.
I think I'm done.
Massive round of applause to Dean. We're a little bit over 12, but the fact that you're able to get all of that into just under an hour, Dean, is actually quite remarkable. So thank you for really making that concise and easy to understand. It may not all sink in. If you didn't catch all of that on the webinar today, I think the message in those scenarios is ask for help if you don't know what you're looking at. If anything sounds like something Dean has discussed today, or which we've put an example out there, and you don't know what you're looking at, and if the contract is more than 3 pages of definitions and 30 pages of content, probably worth getting some help early on before you get to your audit in July or August. I will wrap up really quickly. We've got a whole bunch of slides there again, just to demonstrate, our capability and the solutions we have. We've put our leasing thing in here again because, as always at this time of year, we've seen an uptake in lease accounting. Everybody's realizing that the Excel just doesn't cut it. So just a reminder that we can assist at BDO with both a SaaS solution and an outsourced lease management service solution using our proprietary software. I've had about three queries in the last 2 days alone for lease accounting, and we can actually help with that. So just make sure you're ready for your lease accounting. And on our IFRS and corporate reporting assistance, there's our 4 partners across the country who are currently looking after this: Aletta, myself, Clark, and Lynn. But we're supported by an amazing team below us, including Dean, below us. And kind of just an indication, this is not actually the only members of the team. I think this is becoming the senior members of the team, because the team's getting so big now, all the way down to the lower levels and graduates, that we actually have quite a big support base below this. So certainly got a lot of people there. Our regular insights, please click through to our corporate reporting insights. You can register and subscribe for these to be sent to you. They're all free of charge. It keeps you up to date. We've got education and learning models, some of them free, some of them paid for, depending on what you're looking for. And don't forget sustainability. It's coming, it's still there. So start to think about the data in terms of carbon and reporting, especially on your carbon footprint measurement. Organizations are starting to realize that the right place to start if you're trying to prepare for mandatory reporting is probably a combination of, 1, get your boundaries set for your carbon footprint measurement, and 2, try and report under a framework, even if it's just internal reporting in the first thing, to see if you can do it, almost sort of a gap analysis. And I'll leave you then there with our key contacts in Australia on that. Dean, thank you very much. A little bit longer today than normal, but it was great to have you on the session today. So thank you very much for attending and pulling all that together. And to our
Thank you,
attendees,
Kevin.
see you next time. And those of you interested, on the 26th of June, don't forget our sustainability webinar. In our webinar series on sustainability, mandatory and voluntary reporting is the topic of the month. Have a good day.